Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is what's moving. Today's going to be a little different. I had just completed a virtual event for the Money Show, and I wanted to share my presentation with you because I found out I'm not going to get a copy of the presentation for a couple days. And yeah, there's a lot that happened in the market today, a lot going on. Fed Chair Powell spoke. The market closed pretty weak yesterday. We got some follow through today. But we're going to talk today more about just some more broadly what's taking place and what our expectations are. And you can see me reiterate some of the positions that I like that I've talked about here in recent days and recent weeks. So let's go into this in the presentation here. This was called the aftermath. Coronavirus was a deflationary black swan and central banks unleashed massive liquidity. So the tail end of the growth cycle. Really, what we want to key off on here is ahead of COVID-19, we were already at the tail end of a growth cycle, and global manufacturing PMIs were deteriorating. The pre-COVID data across the board was not strong, and deflation was a trend. As you can see here, these are global manufacturing PMIs through 2017, 2018 were strengthening, but they started to stall late 2018. And everybody last year was talking about the onset of a potential recession. The Fed staved it off, but you can see here, as the COVID outbreak began, the PMIs worsened into really just dismal numbers. As well, COVID data was not strong in other instances, whether it be ISM new orders, but you can see the sharp fall off here, but definitely well off the peak coming into 2018. I mean, we had really started falling off a cliff. The U.S. inflation was declining. It was becoming, signaling the onset of a recession. A lot of the numbers had started to, already tail off a bit. So this is a number of issues that we were looking at heading into it. Now, the COVID-19 response that we've seen, fiscal stimulus measures as a percent of GDP, the top three, Japan 21%, US 11%, Australia 10%. And again, these are not the only governments printing money and sending money out in order to stimulate the economy from shutdowns. But this coupled with unprecedented measures from global central banks, the rate cuts, the balance sheet expansion, and is really what coupled together has been just extraordinary. But this balance sheet expansion was already underway. And you can see here, they expanded the balance sheet from 2008, 2014. It flatlined. Everybody knows they started unwinding it through 2018. But again, they started picking, the Fed expanded the balance sheet. Remember the quarter four last year. We cut rates in September and August, and the balance sheet began picking up. Liquidity was put into the system late in the quarter four of last year to extraordinary levels. And then now, I mean, it's increased 50-60% since the bottoming here. So we've seen extraordinary liquidity hit the market coupled with the fiscal response. Now the impact from COVID, the S&P lost 36% from its peak. It's gained 36% back from its trough. The NASDAQ lost 32%, gained back 41%. We've seen a tremendous snapback in markets across the board. Copper too. And then risk currencies such as the Aussie dollar lost 21% from its peak coming into the year. And then it's gained 19% back. Remember though, percentage gains back are nothing close to the same percentage as that it has lost. Gold, though, a little different. It was more of a deflationary wave that took place March 9th. It started March 9th and 10th, but then it's recovered more back. It's actually made new highs since then. Conclusion, the global economy was heading towards a slowdown and potentially even a recession in 2019. Central banks measures in the second half of 2019 delayed the inevitable. COVID-19 became the deflationary black swan that ended the growth cycle, and these unprecedented measures once again stabilized risk assets. So what's next? We essentially just witnessed what happened in September 2008 and 2000 through 2011 play out in 60 days. Now, I want to explain, before I get into that, there is no comparison from the great financial crisis to COVID-19 pandemic. But there are cycles within, we see it in charts and with Michael's markets, how markets go through those cycles and how they go through recessionary trends. So, there's no similarities in the narrative, but how the markets play out and how the Fed has reacted, there are some similarities. Overall, furthermore, 2007 through 2008 was essentially like January and February of 2020. We saw this sort of play out. It was in hindsight, this sort of crash was coming, and only in hindsight, of course. The narratives are drastically different from, but the cycles again have those similarities. So, one of the backbone here to look at, QE1. This is when the Fed launched QE1, QE2, and QE3. It put the bottom in yields. Now you see here, liquidity heading into the Brexit bottomed out. This is last year when they cut rates, bottomed yields again. So we've seen every time the Fed is expected to, or the situation worsens, yields go lower in anticipation of that Fed action. So now we see something similar here. You have a 50 basis point cut here, and it was sort of that train wreck was taking place. We were expecting growth to slow further. The uncertainty was out there still. So there was 100 basis points still the Fed could cut, and everybody really expected that to happen. And when they did this 100 basis points, it really bottomed yields. We saw a 50, 60 basis point rise in almost 2 days. But this flat line here starts to become a little similar to where we could see sort of a flat line in a way or another before making new lows into here. Now again, it's not a mirrored example, but sort of what we expect as the Fed is likely, and what we've heard from a lot of the central bankers, what we've seen from Washington trying to send out another $3 trillion. But Fed Chair Powell is preparing the market that their job may not be done here. So that's what could send yields lower. Now, if we continue to look at this, you overlay, this is basically 2008 through 2014 on the S&P and the 10-year. So really, it's more about the divergence here. And, we've seen the 10-year yield. This is really where we could be heading into. You get this sort of new low in 10-year yields, and you get volatility picking up again in the equity market. This is the sort of onset that we feel the market is coming into now. And we've started to see it play out a little bit. We've seen yields move up a little bit. I think the only thing holding yields back from making those new lows, I don't want to confuse anybody talking to Treasury prices. Treasury prices is what we trade, but the yields are what we expect to make new lows. Treasury prices would make new highs. But the supply is hitting the market right now with the 10 years yesterday, the 30 years today, and a new record low, 70 basis points on that 10-year yield yesterday. This supply is actually pressuring the prices lower, which is buoying the yields a little bit. And those prices were actually higher today despite that. So we still think that once this supply plays through this week, it could help lift a ceiling on Treasury prices and in turn pressure yields lower. And we're going to get more chop in the equity market and new lows in the 10-year yield. But out of this, the aftermath is where we get a reflation trade, and the equity markets benefit and yields benefit. This is sort of where that taper tantrum began. So that's something we want to kind of keep an eye on. Don't worry about the axis here. This is really for an emphasis on what we think is happening here and taking place right now. So from there, it leads me into this copper-gold ratio versus Treasury yields. And I think the copper-gold ratio is really interesting as it's made new lows too. So you've seen gold move higher. You've seen copper actually hold ground after this recovery so far. But because gold's moved higher, it's pressured that ratio. But it tracks with the 10-year extremely, extremely well. So I do think if we see new lows in the 10-year, which we expect, then you're going to see that copper-gold ratio go higher. And that's going to help, whether it be copper moving lower or gold moving higher, or them ultimately just diverging completely, which we imagine really can happen here. This helps emphasize that narrative. Now, the other narrative we've always talked about is the dollar. Now, the dollar's been in a heck of a consolidation for the past month. But if somebody had told you the unprecedented measures the Fed had done, cutting rates to zero, but the promise of open-ended QE, and then they are buying ETFs, liquid bond ETFs, so corporate bond ETFs. So if someone had told you that before it happened, would your expectations be for the dollar? It would have gotten crushed, and that's not the case. It's holding ground tremendously. I think there's a lot of work behind the scenes. I mean, you even see Merkel today talking the euro higher, but the dollar still finished higher in the session. So coming out of this sort of 2011, 2012 time, when the Fed started to begin unwinding their unprecedented measures, you then saw the 2014 dollar start to strengthen tremendously. Now, I'm not saying we're going to have to see this thing break out the way it had in the past, but we're going to see this ultimately strengthen in the dollar, and that's the way we're playing right now. Next, let's see here. Let's just take a look here. This is sort of what we just discussed. We like being long the dollar. We like being long treasuries. We like being long gold. We like being short copper. We like being short the Aussie dollar. So we discussed here in recent weeks and recent days how we are playing some of this stuff. Our trade alert strategy is one that's long the 5-year right now. Call ladder. We've done many things with clients here at the desk, doing things in the 30-year bond we like. So there's a number of ways to trade it. There's a number of strategies in gold. We like silver a lot too. We think silver, if it can start closing above 16 and a quarter, you're going to get that breakout there. And earlier in the week, I mentioned the copper trade. This very cheap butterfly put spread with about 2 weeks to go in the copper. But give us a call. We're here to help with anything on the board. We're here to help walk you through this stuff that we're doing. And we look forward to hearing from you. Our number 312-278-0500. So give us a call. But remember, futures trading involves substantial risk of loss and is not suitable for all investors. Thanks a lot.